Hello, everyone. Welcome to the quarterly investor call for UTI India Dynamic Equity Fund. The agenda for today's call will be introduction and welcome by Ms. Shweta Roongta, Business and Investment Analytics Analyst at UTI International. Country macro update on India by Mr. Vetri Subramaniam, Chief Investment Officer at UTI AMC. UTI India Dynamic Equity Fund update by Mr. Ravi Gupta. Unfortunately, the portfolio manager, Mr. Ajay Tyagi, won't be able to join the call today due to the sad demise of his father. Mr. Ravi Gupta will be speaking in his absence. He is the assistant portfolio manager of the quality growth strategy and has been working with UTI since 2006. We will now begin with the session. Kindly note, we will also have a Q&A session at the end. Please feel free to post your questions on the chat box anytime during the call. I would now invite Ms. Shweta for the welcome address. Thank you.
Thank you, Shivani. Thank you, everyone, for joining the quarterly update call of the UTI India Dynamic Equity Fund. In today's call, we will be reflecting on a year that has been nothing short of extraordinary for the Indian market. After a lackluster 2022, the Indian markets demonstrated remarkable resilience and scaled new highs in 2023. Amidst a global landscape riddled with uncertainties, India emerged not just unscathed, but stronger. We witnessed Indian equities soaring with a vigor that defied global trends, supported by solid macros and a significant influx of both domestic and foreign investments. Indian markets have truly become a mirror reflecting the aspirations and progress of India itself. What makes 2023 stand out is not just the growth, but the nature of the growth, resilient, consistent, and driven by an internal dynamism that's uniquely Indian. Looking ahead into 2024, we face both challenges and opportunities. It's an event-heavy year, especially with the upcoming elections, which are likely to influence market sentiments and investor outlook. However, we remain positive, primarily due to three key factors: healthy double-digit growth in corporate earnings, boost in private sector investments, and an uptick in consumer spending. Before I conclude, I would like to share a quote from Ray Dalio that beautifully captures the distinctive position of India. India is at a very special moment for a number of reasons. With the combination of education and economics, enough money to invest in the right things, and the way that it's dealing with technology in this environment, it strikes me very much similar to where China was in the 1980s. India's time has come. Thank you. I would now request our CIO, Mr. Vetri Subramaniam, to give us a detailed update on India macro.
Sure. Good afternoon, good evening, good morning, wherever you are. Delighted to be able to join you again for this first webinar in 2024, where we'll be talking about what's going on in India. And we'll also discuss, of course, the India Dynamic Equity Fund. And as Shivani mentioned at the outset, Ajay is unfortunately not here with us today because he lost his father a few days ago. And today is, in fact, the prayer meeting for that, so he couldn't make it here. But we've got Ravi, who's, had more than 17 years experience at UTI and a long amount of time acting as assistant fund manager to Ajay. So he'll be talking about the strategy. And of course, both of us are here to take any questions that you might have. I think a few questions have already come in, but feel free to send in, any further questions that you might have. And Shivani will, pick them up, I guess, from the chat window, and then she'll be able to throw it across to us. So what I'm going to do today is just step back for a moment and look at, I think what's been a pretty remarkable year just in terms of understanding the kind of flows that have happened in the capital markets. Now, I know during many of my travels and visits, and I've met many of you or done calls with you, many of you have wondered about the vigor, vitality of the Indian capital market, how active is the fundraising, because, capital is really the raw material that fuels entrepreneurs. It's the raw material that entrepreneurs and businesses need to be able to grow their businesses. And therefore, in a growing economy, you need a very active market in terms of issuances for companies to be able to access growth capital, particularly younger companies who need that growth capital to be able to, achieve the potential that they have over the future period. And also, many of you would be aware that in India, the story of the last few years has actually been about the resurgence, or rather not the emergence of strong flows from domestic investors. So let's just take a look over these next few slides in terms of the overall picture of some color of both issuances and flows of money. So what you have here on the first slide is the IPO market in India and the fundraising that's been happening in IPOs. 2021 was, of course, the record for IPOs at $16 billion. But 2023 is not too bad either, with little over $6 billion of money getting raised through IPOs. Many of these are young companies who were originally funded by perhaps venture capital or private equity, and now they've come to the market to actually raise fresh equity to continue to power up their growth plans. So not as hectic as 2021, but still quite an active market. In the last 3 years, the team at UTI has actually analyzed close to 130 IPOs. There's a lot of pressure on the team just in terms of keeping track of all the new companies that are coming to the market. On the right side of the slide, you can see offer for sale. This is a regulatory mechanism through which a company which is already listed can effectively make a primary issuance to the public at large. So this route, very popular in the past, not so popular today, but this route also saw about $2.5 billion of issuances, new issuances come to the market. So these two numbers, offer for sale and IPOs put together, about $6 billion and $2.5 billion of supply coming in through these two routes. On the next slide, we've got the numbers for what was happening in certain other segments of the market. Here we are talking about qualified institutional placements. These are placements done by company, which are not really done to the public market at large because they are restricted typically to institutional buyers. So this market again, 2020 was actually the most active market for QIPs. This was the year when many banks raised large amounts of money to sort of, strengthen their balance sheets. But 2023 again has been a pretty active year, more than $6 billion of QIP across sectors, not necessarily only in banks or financial sector, but this has also been large primary issuance. Finally, on the right side, you have another bar chart. And this is the story of India. I think in many of my travels, I've talked to all of you about how India is now the third most active market for venture capital and private equity investment. Now, obviously, companies go through a life cycle where the money is raised from venture capital investors, private equity investors, and over a period of time, many of those companies do find their way to the market for a listing. And post-listing, in many cases, the venture capital funds and PEs have no reason to remain invested. And this year, we have seen the most aggressive sell downs that we have ever seen from this group that I've categorized as promoters, venture capital, and private equity investors. They've sold in excess of $20 billion worth of stock. So these are secondary sales that they've made, but that's really the largest number that dominates these two slides. So put together, you've got close to about $36 billion of supply coming in both through new issuances as well as secondary sales by certain large investors. As I said, this is not an analysis of the entire 100%, but really some of the key elements of what moves, fund flows and supply of stock in the market. So that's about $35 billion of primary and secondary sales. Now, who did the buying? We can see that on the next slide, where we've once again encapsulated the numbers to just think about this in terms of where the supply came from. So the supply came from promoters, venture capital, equity, so on and so forth. So if you add all those numbers together, it's about $35 billion of supply of stock. Where did the demand come from? The demand came from domestic institutional investors who bought nearly $22 billion worth of stock, and the balance $21 billion was bought by foreign portfolio investors. So almost half and half, the total demand of about 45 billion from these two key institutional players. I'm not talking about any demand from retail or, for that matter, sales of stock by retail investors, but just the institutional segment had net demand of about $42 billion, and supply was about $35 billion. But to my mind, these numbers are quite remarkable. This would pretty much qualify as perhaps one of the most robust years that we've ever seen in the markets, in terms of just the sheer volume of both supply, primary and secondary, as well as this very strong demand. Those of you who've been tracking the Indian market, of course, know that the domestic institutional investors, dominated by, of course, the Indian mutual funds, companies like UTI Asset Management Company, this entire industry is now receiving close to almost $1.5 billion to $2 billion of flows on a monthly basis, which is coming through systematic investment plans. These are investors who've chosen to subscribe to a particular fund, and maybe they've signed up to make a small investment. It could be as low as 100 rupees. It could be as large as 10 million rupees or even bigger. But they have committed to invest that amount and perhaps issued an electronic instruction for such an investment to be made over typically a minimum of 12 months. But in some cases, this could even be a sign-up which could go on for 10 years for an investment of that amount. So that's what is giving a lot of visibility in terms of the flows that are coming into equities from domestic investors. And that's the source of the large part of the source of the $22 billion which flew into domestic mutual funds. And of course, the balance coming from foreigners. So that's just a reflection of how active the Indian equity market was last year. So quickly, let's move on from this. Just to look at 2-3 slides on the macro. What we have here is the current Bloomberg forecast. I would just draw your attention to the last two columns, particularly the column for 24. The Bloomberg professional economist forecast for GDP growth in FY24 is 6.6%. It's moved up marginally, but I should just point out that the estimate which has been put out by the statistical agency, because they normally put these numbers out ahead of the presentation of the budget, or in this case, the vote on account, which will happen on 1st of February, they've actually forecast a growth rate in GDP of well above 7%. This has got to do in part with the fact that the deflator is a very marginally low number this year. But be that as it may, the government forecast is above 7%. The RBI forecast for GDP growth in 24 is also above 7%. Professional forecasters are still holding at about 6.6%. And I suspect that the reason they're doing it is that they think that bump up has just got to do more with the way you interpret the deflator from nominal GDP to real GDP. And that's feeding into a much lower growth forecast that they have for FY25. But just looking at trends, I think the risk to the 25 forecast is now more to the upside, just given the kind of trend that we are seeing, which is getting picked up in the high frequency data that government has put out. So that's in a nutshell. Government estimates at 7% GDP. Remember, these numbers will get reiterated on the 1st of Feb when they present the budget, and all the fiscal arithmetic in the budget will be based on that 7% number. And we expect that they will pencil in nominal GDP growth of about 12%, 11 to 12% for FY25, which is the year ended March 25 as well. Moving on to the next slide. Just a very quick overview. Just as we've seen inflation come down in the developed world, particularly in the US, in India as well, you can see on the left-hand slide the lines for inflation, CPI, as well as core inflation. And core inflation in India is giving a very great deal of comfort, I think, to policymakers, where they've got the core inflation rate now down to about 4%. This is even pretty much the lowest that we've seen, even from the pre-COVID era, and sort of puts us in a good place in terms of hitting that target of 4% plus or minus 2%. And I'll talk about that target later on. On the right side, you can see the India repo rate and the US repo rate. Of course, markets are now expecting 140 basis points points of rate cuts in the US in 2024. But we do have the Fed governor saying that looks excessive. In India, the markets are still quite muted in terms of what's getting priced in terms of rate cuts. About 50 basis points is the expectation during the current year. And that will sort of ensure that the historical relationship between the India repo and the US repo perhaps will look more like what it used to in the past, rather than the very narrow gap that we have today, which is quite unusual in a historical context. Though I do expect that this gap in the future will look less than in the past, simply because now the inflation targets between the two countries the gap between those two inflation targets is much lower. Move on from that to a quick wrap of where we are on capital expenditure. This is something that Shweta mentioned as well. And in the past, we've shown you slides on the strength of corporate balance sheets as well as the good sort of health being demonstrated on bank balance sheets, both in terms of capital adequacy as well as a very low level of non-performing assets. In fact, the best that I have seen in almost 20 years, both on the corporate side and on the bank balance sheet side, which suggests that the enabling conditions for companies to do capex are now very much in place, simply because their own financials are in great shape, and the banks also potentially have risk appetite to lend because their balance sheets are strong. A lot of the discussion over capex, when you look at the slide, has got to do with these bars, which are looking only at the capex done by government and done by what we call CPSEs. CPSEs are nothing but public sector entities which belong to the central government. Now, if you look at this bar, what you'll notice is that the actual trajectory of combined capital outlay has not moved too much, right? You look at, let's say, FY 18 or 19, the total amount of spending on capital expenditure by government plus CPSEs put together was about 3.8, 3.9%. For the current year, we think it will remain at that 3.8% number. What has changed within these two numbers is the composition. The spending by government, which can be called the center, has actually moved up dramatically. So the government, which was spending 1.6% of its of GDP as capex, has increased that number from 2019 to 24 BE being the budget estimate, to about 2.7%, whereas the central public sector enterprises have actually curtailed some of their capital expenditure. Some of this has to do with their own sort of situation, but it's also perhaps in some cases a function of the fact that they've chosen to dividend this money back to their shareholders. Remember, the government is a dominant shareholder in many CPSEs, and therefore the government has then recycled this money into capex. So the discussion about a huge jump in capex is true when you look at the government number, on budget number. But when you look at total capex done by government plus CPSEs, it has not really moved that much. Not to say that there has been no qualitative improvement in the structure of budget spending by the union government. There is a significant shift which has happened towards capex as opposed to revenue expenditure, and that perhaps will eventually lead to a better multiplier within the economy. And secondly, it has perhaps therefore had less of a role in fueling inflation rather than putting money into people's pockets through revenue expenditure, which we've seen in many other parts of the world has actually tended to be a driver of inflation as opposed to capex. So capital expenditure trends are stable. I think the hope and who can provide a delta to capex remains the private sector along with the households, because remember, India has not had a proper real estate cycle now for almost a decade, but we are seeing in the last 2 years certainly signs of a pretty significant pickup, certainly among large listed developers, but more urban centric. So we need more data to see whether that's a sustainable trend. Moving on quickly to slides on, if you can just move the slide.
But we are looking at the slide on the EPS trend.
Oh, okay. Sorry, I seem to have lost that. But anyway, I've got the slide. So I would just say that when you look at the EPS, what I would point to is that the FY24 EPS number, if you look at its progression over the last 4 quarters, it's declined, but it's not declined by too much. And that's unusual in the Indian context because typically the declines have been, to the tune of even 5% or 6%. There is a decline this time, but it's closer to about 3%. The implied earnings growth for 25 and 26 is still running in sort of the mid-teens. So that's sort of the market expectation of where earnings growth will be. The next two slides look at valuations. First off, the Nifty 50. Remember, the Nifty 50 is a reflection of large cap valuations. Have you got that slide, Ravi?
Yeah, we are looking at the Nifty.
Okay, it's moving a bit slowly at my end, but no worries. I have it on my other desk. So when you look at the Nifty 50 earnings, what you essentially see is that on the right side, there's a significant pickup in return on equity. And that's also driven in part the re-rating of the market when you look at the multiple on the left side, which is on price to book. And I'd say the interesting dichotomy in the marketplace is that the large caps are richly valued, but I'd still say they are somewhere within fair value, which we define as long-term average plus or minus one standard deviation. Large cap valuations in India are not really blinking red in terms of being super expensive. And remember, last year, the large cap index was in India, the domestic Nifty 50 large cap index was up, in the low teens. It was really the mid caps and small caps, which had almost like a banner year, 45, 46% up for the year. And they have really pulled their valuations significantly higher, which you can see on the next slide. The mid-cap valuations, we have in the past seen cycles where mid-cap valuations have gone to a premium. On the slide, what you're seeing is the price to book of the Nifty mid-cap on the left-hand side. That's the 150 mid-cap companies. And on the right side, the Nifty small-cap 250. And this is one of the, this is perhaps the only time in my career where I'm actually seeing that small cap index trade at a premium to where the large cap index is. Mid caps, we have seen cycles in the past where they trade up to a premium, and they have tended to mean revert over 2 to 3 years back to sort of a historical parity with large caps. But it's really these small caps which are a big surprise that they've traded up to a premium. I would submit that some of this has got to do with the strength of domestic flows. We talked about those flows earlier. A big share of the flows that came in 23 into equity mutual funds in particular were dominated by flows that went into what we call mid-cap and small-cap funds in India. So there is a little bit of a concern about valuations in that small-cap space because, I think it's quite unusual to see those small-cap companies trading at a valuation. I'm not sure it is fully deserved. These are companies which figure lower down in the food chain, vendors, suppliers to larger companies, more affected by economic cycles. They don't have the depth and breadth of management that larger companies tend to have. They find it difficult to navigate changes which could be related to regulations, both domestic and foreign. And those are many of the reasons why typically we found small caps tend to trade at a discount. But for whatever set of reasons, they've gone up to a premium, and that does gives us some reason and cause for concern. So very quickly, moving on to the next slide. Ravi, if you could, yeah, sure. So as I said, the US expectation 140 basis points of rate cut. We're not so bullish about rate cuts in India for two reasons. One, just given the fact that the RBI governor in particular now talks about the target for inflation being 4%. He says, yes, there is a band of 4 plus or minus 2, but we in India now need to focus on 4 rather than use the band as leeway. Under those circumstances, we think, the sort of headroom to really cut rates in India is low. Secondly, if growth is 7% plus, there is really no pressure on, the MPC at this point of time to say, look, growth is struggling. We need to start cutting rates because growth seems to be doing quite well at 7% in any case. So we would tend to think that, first of all, the Indian policymakers will obviously watch what's happening in the US. They would rather see the US start to cut before they do anything. And even if they do, keeping in mind the growth context in India, and the desire to target 4%, we think rate cuts in India, if at all, will be back-ended, and we don't expect them to be aggressive at all. Nifty 50 consensus earnings growth 15% for March 24. We are halfway through the third quarter results. That's the results for December. There have been some disappointments, but I'd still say let's wait for the season to get complete. I think 14-15%, mid-teens still looks within reach, and next year as well, the ask rate is not too high. The challenge is obviously, while we could still argue that the Nifty valuations are somewhere in the comfort zone, slightly rich, but somewhere in the comfort zone, it's the mid cap and small cap which are looking a lot more problematic. They're quite rich. They're unusually trading at a premium to large caps. And I think, that's our advice to investors in India as well, to stagger their investments, to stick to what they are doing in terms of investing through those systematic plans that I described, and to sort of rebalance their portfolio mixes based on their own financial goals between debt, fixed income and equity, and also within equity to look at their large, mid, small allocations. So that's been our sort of advice to retail investors in India. But as of now, I must say the money is still sort of pouring in like crazy into the small caps. So that's been, sort of follow the momentum, follow the performance is what we are seeing in terms of flows. But I'll halt over here and hand over now to Ravi. And Ravi is going to run you through, sort of just a reaffirmation of how we run IDEF, and then share some key insights into the fund. Over to you, Ravi.
Thank you, Vetri. Good morning, good afternoon, and good evening to everyone. I'll just start with a brief recap of the investment philosophy that we follow for the fund. The investment philosophy for the fund is basically based on three key tenets of quality, growth, and valuation. The first filter is that of quality, which we define by the ability of any business to generate economic value through generating high return on capital or high ROAs in case of banks and NBFCs across business cycles, in addition to generating high cash flows on a consistent basis. So we look for companies with a track record of 5 to 10 years of sustainable and steady return on capital and cash flow generation. Once a company is filtered into the quality parameter, we look for growth aspects within the company. We look for the track record of earnings compounding over the previous 5 to 10 years, and try and identify whether the company has in place modes which can enable it to compound earnings at a high rate over the next 5 to 10 years. And we look for drivers for these companies which are secular in nature and not cyclical. These two parameters of quality and growth help us identify the kind of companies that we want to invest in. And once we have identified these, we move on to the next parameter of valuation, where the focus is predominantly on cash flow based valuation and intrinsic value. With that brief introduction, I'll just move on to the strategy performance. So after a very challenging 2022, where the fund significantly underperformed the benchmark, 2023 has been a year of consolidation and catch up for the strategy, where over the 1 year period ending December 23, the fund or the strategy returns are just in line with the benchmark. Now, the drag that we saw in 2022 continues to impact or pull down the 3-year performance as well. But if we were to move on to slightly longer term horizons of 5 years, 7 years, and 10 years, we see that the outperformance is still maintained. The important points to discuss here is what are the factors that actually impacted the performance of the fund over the last 1 year. So I'll first start by referring to the key detractors. Over the last couple of years, we have seen the global economy emerge from the disruption caused by 2022 by the pandemic and a significant cyclical recovery in some of the sectors like construction, real estate, automobiles, etc., which benefited companies like the ones on the screen right now, Larsen & Toubro, Tata Motors, M&M. These were some of the top detractors to performance. Some of the top performers in the benchmark, which the fund does not hold. If you look at the data on the table, you can see that while the companies have benefited over the last 1 or 2 years from the cyclical recovery, The longer term data, both in terms of growth as well as quality measured by return on invested capital, continues to remain inferior and is basically subpar with very, very low growth and return on invested capital. As such, these companies do not match our investment philosophy. These companies do not qualify when we look for the quality and growth parameters that I discussed earlier, and hence we have no exposure to these companies. And a very sharp rally in the stock prices of these companies was one of the most significant contributors to the drag on the performance. The second aspect was a very sharp rally in some value names from sectors like tobacco, where ITC, India's leading tobacco company, power utilities, where companies like National Thermal Power Corporation and Power Grid, and defense sector, where Bharat Electronics, India's leading defense manufacturer. These are some of the sector companies which did very well as a part of the value rally. Again, we do not have exposure to these set of names, and that has also impacted performance over the last 1 year. From our holdings, what did impact us negatively was underperformance of some of the large cap growth companies. We've seen that over the last 1 year, due to very sharp interest rate hikes, valuations of some of the growth companies have actually been impacted. And despite the performance on growth holding up quite well, this derating in valuation of companies like Avenue Supermarts, Bajaj Finance, which are amongst our top holdings, they did get impacted, impacting the fund performance. And finally, we did see a very sharp rally in a very, very particular segment, which is known as state-owned enterprise, where again, stocks of these companies outperformed the benchmark. And since we don't have any investments or any exposure to public sector entities, this also ended up impacting the performance. What did work well for us, or what did support us in the last 1 year, is no exposure to the Adani Group. We do not like these businesses predominantly because of their capital intensive nature, as well as the propensity to have high leverage on the balance sheet. So as such, they do not fit into our investment philosophy. We have never had any exposure to this group of companies, and we don't intend to have any exposure in the near term as well. So a correction in these companies actually impacted us positively. We maintained our overweight position on IT services, despite the sector seeing some bit of challenge in 2022. And predominantly amongst them, we maintained our exposure into mid-tier companies, where our thesis is that the prospects or the potential for long-term growth in mid-tier IT companies is actually much more superior to the larger tiers. And these companies have performed well over the last 1 year, which has contributed positively to the performance. And finally, as all of us know, mid and small caps have done quite well over the last 1 year. The portfolio maintains on an average 35 to 40% exposure to mid and small cap companies. And some of the holdings within this bucket have also performed quite significantly, which has helped us in maintaining performance over the last 1 year. Just to put the performance discussion into perspective, it's important to look at the divergence in the performance of the value segment and the quality segment of the market, the two very prevalent styles of investing, both in India as well as the global markets. Now, if you look at the bottom two tables, we have compared the returns generated by the quality and value index, both in the US market as well as the world market, using the MSCI indices. And if you notice, in 2022, after a very significant underperformance, quality has bounced back in 2023, both in the US as well as the broader global market, and has outperformed significantly over value. However, in India, that trend has still not started to play out. We are still seeing that during the last calendar year as well. The value segment continued to outperform quality. And since the portfolio has a quality orientation, this trend in the market continues to impact the fund performance over the last 1 year as well. This chart presents the PE premium of the strategy versus the benchmark. So on a longer term basis, the average premium that the strategy has traded at over the benchmark has been around 40%. And what we see on this chart here is that over the last 2 years, the strategy has actually been at a discount or at a lower premium compared to the average that we have seen over the last 1 decade or more. So with a combined effect of a value segment doing very well, which pulls up the valuation of the benchmark, and some of our top holdings in the growth quality bucket not doing that well or witnessing a derating, the valuation of the portfolio has been lower than what it has been in the past, and the combined result puts us in a position where the strategy premium is actually at a discount to the benchmark. I'll just move on to talk about a couple of examples which present our stock selection framework. The first amongst them is Poly Medicure. This is a company which is into the disposable medical equipment markets in India. It's a leading supplier of disposable medical equipment, predominantly infusion therapy related products in India. It has a fairly large product basket of around 160 products. Exports play a very significant role. So two-thirds of the revenues of the company are actually from exports. The company exports to more than 100 countries globally. Why we like this company and this segment is basically because of the global size of the medical devices market, which is at $450 billion, growing at a 6% rate. Whereas if you look at the Indian market, while currently it's much smaller in size at around $10 to $12 billion, it's actually growing at a faster rate, 1.5 times the rate at which the global market is growing. And more importantly, 70 to 80% of the medical devices market in India is catered to by imports. So any leading distributor or producer of such equipment and products in India actually tends to benefit from the import substitution opportunity that we feel can play out over the next several years in India. So that's the reason why we like this company, and some of the other growth drivers that the company has in its favor is foray into US market. It has recently launched products in the renal or kidney segment, where they have products in dialysis consumables and dialysis machines. So scale up in this segment is also seen as a long-term growth driver. And in addition to that, we do expect company over a period of time to get into the critical care segment as well. Historically, the company has delivered 16% growth over the last 10 years in revenues and around 22% growth over the last 10 years in its profit after tax. This is well supported by growth in both the domestic market as well as the international market. And the company has achieved this growth while maintaining very steady 20% kind of average return on capital and a very high cash flow conversion of around 75%. The second example is of an IT company. I did refer to earlier that our preference within the IT services sector is basically more on mid-tier companies. So this is a prime example of that. Coforge Limited is a company which is a diversified company into the IT services segment, catering to verticals like insurance, banking and financial services, and travel and transportation. It derives almost half of its revenues from the American market, and around 37% from Europe and Middle East. Why we like this company is basically for the fact that the company has been one of the fastest growing companies in the mid-tier IT services segment, driven by its diversified business mix, its impressive, very strong sales-oriented culture in the management team, and a very, very good execution track record, which has enabled the company to actually participate in multiple large-size deals over the last few years, expand its addressable market by getting into newer verticals like healthcare and high-tech. And as a consequence of increase in size, the company has managed to improve its margins, and those incremental margins are being reinvested into the business to drive and create opportunities for growth in the future as well. If you look at the historical track record of the company, again, a very steady 15% growth delivered over the last 10 years, along with close to 20% average ROICs and a 75% cash flow conversion rate. Now we come to the sectoral composition of the fund as it stands today vis-a-vis the composition 1 year back. So very similar in terms of the breakup. 25% exposure to banking and financial services, another 25% or to consumer goods and services are the two main categories that the fund has exposure to. The other segments that we like and prefer to invest in are information technology, healthcare, and automobile. And as I discussed earlier, some of the cyclical sectors and commodities like energy, construction, metals, and minings are sectors where the fund has historically not had any exposure, and we continue to remain away from these sectors even today. These are the top 15 holdings of the fund. Again, a comparison of the situation today vis-a-vis the composition 1 year back. Very similar names, not much of a change in the top holdings, other than the fact that gradually over the last 1 year, we have incrementally increased position in some of the names in the consumer services and consumer goods segment, and also selectively within the healthcare segment. But other than that, the composition of the top 15 holdings is very similar. We do continue to look continuously for companies which fit into our investment philosophy with the capability to deliver long-term growth with superior return on capital. And on these two parameters, we identified two companies that we have invested into during the last 12 months. The first one is Dixon Technologies. It is India's leading electronics manufacturing services company. It designs and manufactures goods within categories like mobile phones, consumer electronics, lighting equipment, consumer appliances, security solutions, etc. for global customers like Samsung, Xiaomi, Panasonic, etc. The company is a company which is benefiting quite significantly from some of the government's initiatives like the production link incentive scheme that the government has announced. Historically as well, by way of its execution, as well as by continuously looking to expand its product categories, the company has managed to deliver growth at in excess of 30% annualized while maintaining an average return on capital of 20%. The second company that we introduced in the portfolio in this year was Polycab. This is one of India's leading cables and wires manufacturer with around 16% market share. The company is also gradually diversified into adjacent categories of switches and switchgears, and then gradually into consumer appliances. We look at this as a play on an indirect play on the significant growth opportunities in India through areas like construction, real estate, and urban infrastructure. And the track record of the company over the last 7 years, for which we have data, again, the company has delivered in excess of 30% growth while maintaining around 18 to 19% return on capital and a net cash positive balance sheet. So two examples of how we're looking for companies that fit into our investment philosophy of high quality and high growth. This slide in a nutshell presents the activity within the fund where we continuously look to trim exposure into companies where the valuations have become expensive and reallocate that capital to companies where stocks have corrected and valuations look attractive. So for example, if you look at Info Edge, which was one of the top sell trades in the calendar year 2020, right at the top, actually witnessed correction in 2022 when technology related companies were actually seeing massive drawdowns, and we actually increase our exposure into Info Edge in calendar year 2022. Consequently, it is now emerging as the top buy during 2022. Another example of Dr. Lal PathLabs. Again, in calendar year 21, it was amongst the top sell transactions for the fund, given that it has delivered close to 60% annualized returns over the last 2 years, and valuation started to look expensive. We trimmed down our position. During 2023, while the whole sector was actually going through a challenging period, with 2-year returns actually being negative 30%, we tested our conviction. We continued to maintain our view of the company being able to generate superior growth over the long term, and even that the valuations had corrected, we had actually started to reinvest and reallocate capital into this company, and hence Dr. Lal PathLabs is one of our top buys in 2023. With that, we come to the end of our presentation, and we can now open the floor for question and answers. Over to you, Shivani.
Thank you, Ravi. Could you please stop share? Yeah, thank you. So the first question is for Vetri. The Indian equity market has delivered robust returns over the past couple of years, and valuations appear to be rich at the moment. What factors do you believe will influence the market's valuation going ahead?
So I would say, if you look at those charts that I presented, the mid and small caps, certainly for a variety of reasons, are the areas where the valuation concerns are, I think, very, very elevated. If you actually talk about large cap stocks in India, while they are above the long-term average, they're not in a completely uncomfortable zone. So I would just parse over there to say that large cap valuations in India are somewhere within that plus or minus 1 standard deviation zone. Sure, is it a great buying opportunity? Maybe not, but then how long do you wait on the sidelines waiting for valuations hopefully at some point of time to drop to the minus 1 standard deviation level? So that's sort of my take on valuations. But I'll also add to that I think we are in a phase where it's sort of show me the money. And so to speak, look, I think a lot of the growth potential is getting factored into the stock prices. And therefore, now execution is a hurdle at which the market cannot fail. And the way I would define execution is that you've got to be able to continuously deliver those double-digit earnings growth numbers, right? So if the market is sort of discounting 14-15%, I'd say that's the sort of hygiene number that the market needs to deliver. And if it wants to surprise, it needs to do even better than that number. So that's the high bar that we have, and really it's all about execution. It's all about delivering on the potential that is there. Just very quickly, Shivani, also noticed a question in Q&A where somebody is asked about, everybody's talking about India as the second China. Is this all hype? Again, I don't know the answer to that. I'm sure the history books will answer it 30 years from now. I'm happy to circle back if I'm around or anybody else is around to have this conversation. But all I'll say is that, look, much like that Delio comment, the setup is in place for India to enjoy a good period of steady, profitable growth, which can be rewarding for its citizens as well as for those who provide capital. But as Steve Jobs once famously remarked, ideas are worthless, and it is really the execution which is the multiplier. So I think it's really all boils down to the execution risk that we have today in India, that we need those 5, 10, 20 years at which GDP steadily compounds at 6.5-7% a year without anything seriously going wrong in that setup.
Thank you, Vetri. The next question is also for you. What are the most important factors to consider for long-term investors to invest in India? There are various positives of the Indian economy being highlighted in the media, but are there any factors that are being overlooked? What are the potential risks?
Sure. So, I won't talk too much about the positives because I think the positives are well known, and we've talked about it in many presentations in IDEF as well, and a lot of the literature that we put out talks about that. Where are the risks? Well, I think some of, and these are more short-term cyclical risks. Obviously one risk that many foreign investors in particularly ask about is elections. I would say just reading the sort of political winds and what we are seeing, it looks like the base case is that the current government is able to win a term quite handsomely again. So not really seeing any significant political risk from that point of view, that suddenly you have a change in who dominates parliament and who's running government. So I'd put that as a low risk, but an election is a risk. So I can't say it's a zero risk, so to speak. I think the second risk that I would point to is the fact that, as much as the government has done the heavy lifting in terms of capex, the private sector is still not fully sort of displaying those animal spirits. And I think we do need the private sector, which has got strong balance sheets at this point of time, to come forward with that. I think there are multiple factors, right, including this whole, need for supply chains to move away from China, but people also talk about nearshoring. There is this talk about having greater resilience of supply chains within the national borders, and that all impacts the way entrepreneurs think about when they are investing and building capacity, not just for the domestic market but for the global market. So I think that sort of a backdrop is not one which is very favorable for entrepreneurs to really get aggressive in terms of the animal spirits. Other than that, I would say, global risks will certainly play a role. So geopolitics, any surprises out of the Fed in terms of policy, both to the upside and to the downside, all of those are risks that you should expect will find echoes in India.
Thank you, Vetri. The next two questions are for you, Ravi. I'm clubbing both the questions. The fund has gone through a period of underperformance over the past couple of years. What are the key factors that have impacted the performance? And what are the factors that give us confidence about the fund outperforming going ahead?
Sure. So I did allude to some of the factors and contributors to the underperformance of the fund during my presentation. And just to reiterate, the two most important or significant factors that have impacted performance over the last couple of years is one, a very, very strong cyclical recovery in the global economy and as well in the Indian market as well, which benefited companies in sectors like real estate, construction, where we do not have any exposure. The second factor that impacted us was accelerated interest rate hikes, leading to a downward revision in valuations of some of our top holdings in the quality growth bucket, which again impacted the performance of the portfolio negatively. Now, I do have some data that I can share here to explain this performance. Just give me a second. Please let me know if the screen is visible.
Yes, it's visible, Ravi.
Sure. So I did mention a few names earlier in my presentation. Now, what we have tried to do here on this slide is to present data on some of the key detractors for the fund over the last couple of years, which the fund does not hold, and superimpose it or compare it with some of the top holdings in the fund or some of the holdings which have been top detractors for the fund over the last couple of years. Now, if you compare these two tables, on the left-hand side are the non-holdings in the portfolio, the right side are the portfolio holdings. It's very, very evident that despite a very strong cyclical recovery, the long-term revenue growth, PAT growth, as well as the quality parameters of ROIC and return on assets for the financial services sector is inferior for the set of companies that have actually been the top detractors for the fund over the last couple of years. And if you compare this to some of our top holdings, while the valuations have seen a derating over the last couple of years, there has been absolutely no impact in terms of any sort of pressure on either their revenue growth or their profitability or the return on capital. If we consolidate this data and look at the aggregate basis of both the portfolio as well as the benchmark, if we look at the 1 year number, the benchmark has actually caught up quite well in almost all parameters of growth, operating profit, return on invested capital, and leverage. But if we continue to expand our horizons a little bit further to 3 years, we'll see that despite a 1-year super performance, at the composite basis, the index or the benchmark is still inferior to the portfolio. And if we go to the 5-year, 7-year, and 10-year period, again, the portfolio's characteristics on both growth as well as quality are much superior to where the benchmark is. Now, the focus of the investment team is basically to continue to maintain this superiority in quality and growth of the portfolio, and we are confident that while there might be periods in between where the performance of the fund gets impacted through different cycles in the market, if we are able to deliver consistently this quality of long-term performance on a fundamental basis, the long-term performance of the fund will also take care of itself. Just to club that and answer the second part of the question, what gives us confidence that there could possibly be a turnaround? If you look at valuations here, I alluded to the valuation or the PE premium of the strategy versus the benchmark, and highlighted that we have been below our average premium for the last 2 years. Here again, I've used the same set of companies that I referred to earlier and presented their valuation at the current time versus what has been their long-term average in 5 years or a 10-year basis. Now, if you see the top performers in the market, which is the first table, the current valuations are at a premium for all these companies, whether you look at 5-year averages or you look at the 10-year averages. Vis-a-vis that, if you look at the bottom table, some of the top holdings in the portfolio, current valuations, while on an absolute basis may look higher, as compared to their 5-year and in fact even their 10-year average valuations, the companies are either at a discount or at best somewhere close to average valuations. So a combination of both these factors of superior fundamental characteristics of the portfolio, as well as the difference in valuations of the two segments in the market compared to their historical averages, does give us confidence that we are probably at a phase where the cyclical rally or the value rally is somewhere close to its peak. Whether it starts to turn around tomorrow or takes 6 months, I can't guess that. But yes, the data that I've just presented does give us confidence that over a period of time, that catch-up should start to play out. Over to you, Shivani.
Thank you, Ravi. The next question is for Vetri. How has India changed under the 2 terms of the current government? Which are the areas where the government needs to focus more strongly going ahead?
Sure. So I would say the 2 areas where we've certainly seen, very significant change in thought process. One is really the whole focus on fiscal discipline. This government, except for the COVID-related spike in fiscal deficit, which was unavoidable because the revenues didn't come in. It wasn't like government gave big fiscal handaways. But in general, they have stayed on the path of fiscal discipline. The quality of the fiscal reporting has also improved. It may not show up in the decline in the fiscal deficit, but a lot of items which were off balance sheet have all now been moved on balance sheet. So you could look at the target of 4.5% fiscal deficit for 26 and say, look, that's not too different from where we were in, say, 2015. But the reality is that it's qualitatively very different because everything that was off balance sheet is now on balance sheet. The second thing within the fiscal deficit itself is that the quality of spending has improved because you've pivoted towards capex and away from revenue expenditure. So I think the fisc is one area where I would say we have seen a dramatic change in the way this government has addressed it. The second issue is, I think, the coordination between the central bank and the government. And in a way, I think it goes back to the fact that, Parliament has blessed the flexible inflation targeting regime in which RBI is responsible for 4 plus or minus 2%. But in a way, government has used all policy levers available to it to intervene in the markets, whether it is to curtail the rise in fuel prices, allow some of that to flow onto your fiscal books. And when fuel prices come down, recoup what you have done to sort of, cap fuel prices in the short term. food prices go up, you've capped exports out of India to ensure that domestic food prices don't go up in line with what's happening in international markets. We can have a separate discussion about whether this is a good policy toolkit or not. But my simple point would be that there is a much better sense of coordination, with the thought process being that we want to make sure that inflation stays within what we believe is the comfortable level and sustainable level for the economy to grow over the long term. So I would say these are two very significant differences that we've seen with this particular government over the last 2 years. The final point I will make, and this really goes back to what I said earlier, is execution. I think one of the things which I would certainly give this government a lot of credit for is their execution ability. This is visible in the way where India carried out its vaccination program. More than 1.2 billion people have been vaccinated in a program that was led through a technology platform. And we see this in many senses in government activities where using technology, using a mission mode, which is to, have a central not really planning, but a centralized system of monitoring that policies are getting delivered right down to the lowest level where they interact with the citizen. I think this sort of purposeful execution and sort of private sector focus on getting the numbers is something that I would say distinguishes this government just in terms of its execution capability vis-a-vis governments we've seen in the past.
Thank you, Vetri. The next question is also for you. JP Morgan will start adding India to their EM government bond index, and Bloomberg should follow the suit. What are the consequences for India as a whole?
Sure. I think it, obviously opens up the debt capital market more than what it is today. So you have a lot more foreign participation. In a way, I would also argue then it, enforces a level of discipline on government and RBI, because now you have another large constituent in the market who is looking at how you are managing your fiscal and monetary base and comparing it to how other geographies are doing. So I think, to my mind, that would bring discipline on the marketplace. To anybody who thinks that there can be a very violent move in either the exchange rate or in interest rates in India because of this opening, I don't think so. The reason I don't think so is that RBI wants this to be a smooth process. RBI believes that certain levels of the exchange rate, certain levels of the interest rate are required to manage the monetary base at this point of time. And they have enough tools available to them to make sure that there is no major destabilization of the market just because of a rush of money coming in or a rush of money going out. A very simple way that I could see them do this is, for example, they have already entered into a large number of foreign contracts in the currency market. So you could see that unwind as you start to see a flow of dollars into the market by foreigners buying bonds. Similarly, they were the biggest buyers of bonds. They sort of stepped in to fill the gap when the COVID-related pandemic happened, and one could argue that they have a lot more bonds on their books than they would normally need to have, and therefore I would actually see them aggressively sort of entering the market to supply bonds as you start to see this demand come through from foreign funds. So I would say some movement in the market, but don't expect it to be too dramatic, because the RBI is a player in the market. They have a balance sheet, and they will just use this opportunity to reposition their balance sheet rather than allow the market to materially move in a step function either on rates or on currency.
Thank you, Vetri. The next question is also for you. With China starting to ramp up stimulus, we have seen commodity prices increasing. Do you think this evolution, which could bring inflation, pose a risk of derailing the Indian growth rate?
Honestly, no, I don't see too much risk from that. We don't want China exporting their deflation to the rest of the world. I think that would actually cause a wholly different set of problems that we are unprepared for at this point of time. I mean, the whole world, not just India. So it would be good if China could get its domestic house sort of at least chugging along and not becoming a sort of production just to dump in overseas markets simply because their own home market has gone soft at this point of time. So if China is not not exporting deflation, I think that is a good thing. If commodity prices see a little bit of a tick up, it's not a bad thing. I think most Indian commodity players would be happy to see some tick up in prices. The current prices are at a level where they are making money, but that's only because many of them are extremely competitive in terms of their positioning on the cost curve. So I don't see China's reflation attempt, which is to more address their own domestic problems, as a threat in any way to India. Very quickly, I saw somebody ask two more questions about China on the chat. One was something about reshoring from China. Obviously, India is trying to get a benefit of that. I think the biggest example of that is Apple, who's looking to have at least 20% of their production of iPhones come out of India. They've also already made significant progress. But the reality is India is not the only company looking for a market share of supply chains looking to move out of China. You've got Indonesia in the mix, you've got Malaysia in the mix, and of course, how can I forget, you've got Vietnam in the mix, which has certainly grabbed a lot of the manufacturing moving out of China. And from what I hear and what I see, you've obviously got Mexico as well lining up to benefit, being next door to the US in terms of a location. So I think we'll gain our market share, but it's not like you will see an en masse shift go from China to India, simply because nobody wants to just replace one risk with another 100% risk. And secondly, there are a lot more people competing for that. I'm not sure about this inverse correlation with the Chinese stock market. I would argue that the Indian stock market has been beating a very good tune. Look at the 20 years numbers in INR terms. It's a CAGR of somewhere around 15 to 16%. Sorry, closer to 17% actually as of date. So very short periods of time, there could be some foreign investors who flip a switch and go between India and China. But I'd say the Indian growth story has a lot more legs. Capital allocation in India has been far more disciplined. The discipline of earning a high return on capital among entrepreneurs in India has been a market-enforced discipline. And I think, therefore, the longer-term prospects of India will be driven by that. It's nothing to do with this China on-off syndrome.
Thank you, Vetri. This is the last question again for you, Vetri. Who will be the marginal investors in India market in 2024? Who will be supporting the market in 2024? Domestic investors or QFIs?
Very difficult question to answer. It's easier to see fund flows after they are done at the end of the year, like in the presentation I did, rather than to put a forecast of what it might look like for the next year. I've always held that forecasting the market is level 1 difficulty. Forecasting who will participate is actually level 2 or level 3 difficulty. So I'm not sure I have an answer to that. But I do think the domestic flows will hold up. Simply because a lot of them are through that systematic route. So 1.5 to 2 billion should, sort of support the flow. I think for the economy to do well, risk capital is important. India's net FDI has actually declined. It's declined not because we are not receiving FDI, but there's a cycle of old venture capital and PE money which is taking an exit, and that's why net FDI is slightly low. I'd like to see that FDI number go up because, again, that provides risk capital for entrepreneurs, and it's entrepreneurs who create growth. Growth doesn't happen in isolation or in a silo. So therefore, we do need that additional capital to come in. Hopefully, FDI will prove more material next year. This year, net FDI was actually quite weak because of the withdrawals that I talked about. FPI money, I do get the sense from, so that's the money coming directly into the stock market from foreigners. I do get the sense that while most investors we talk to across the world say, look, we'd like to put money to work in India, my gut feel is that many of them are still holding back, saying better valuations. And therefore, my underlying presumption has been if for whatever reasons you see the Indian market sell off, you'll most probably see better support come into the large caps, which is where I think the foreign money will flow in first, rather than in the mid and the small caps, where anyway, to my mind, the valuation risk is slightly higher.
Thank you, Vetri and Ravi, for the very insightful session. And thank you to all the attendees for taking the time to join the call. Please feel free to write to us for any further questions. Thank you, everyone.
Thank you.
Thank you, Shivani, Shweta, and thanks, Ravi.
Thank you.
Thank you, everybody. Have a great day.
Thank you.